Of course, this is not financial advice and for entertainment purposes only. These two ETFs pay high monthly dividends with no NAV erosion, and they are great for growth and long-term investing, and that is going to be NEOSYS, SPYI, and QQQI. Investors, yes, we have just two ETFs by NEOS, which are the most reliable, consistent, and even the best two ETFs, in my opinion, for monthly dividends, and they are great for any sort of ETF portfolio if you want monthly income and even growth for the S&P 500, that of SPYI, or even the NASDAQ 100 for QQQI. SPYI and even QQQI have been performing super great this year and even since inception, so I reached out to Mr. Troy Cates, the co-founder and managing partner of NEOS Investments, to provide a complete walkthrough of why SPYI and QQQI have been performing so well. We go over why SPYI and even QQQI are great investments for monthly dividends. We also provide why it's been performing super well as of recently, even how to properly hedge an ETF just like SPYI and even QQQI. We go over the income, the portfolio within the ETF, and even so much more. The risks, the pros, the cons, the full complete review is all in this video. Once again, as always, everybody in our ETF Academy already saw this video. You also got access to my own portfolio with over 250, about there, $1,000 in my portfolio. You also get price targets on both SPYI and QQQI, which is super important. And you also get access to ask questions to NEOS and even other ETF issuers. And also, you get a full and complete 45 plus chapter guide with NEOSYS, SPYI, and QQQI, and even how to properly hedge ETFs with our ETF Academy Ultimate Guide to invest in ETFs and so much more. So be sure to check out the link in the description of this video and in the pinned comment section to join our ETF Academy. Now, if you will, please welcome Mr. Troy Cates, the co-founder and managing partner of NEOS Investments.
No, thanks for having me. I'm happy to be here. Happy to have another conversation and talk our ETFs. NEOS has been doing great. We have 12 ETFs out now. Still rounding out our suite of ETFs. Thinking really as NEOS as a solutions provider when you're thinking about income for your portfolio, whether it's equity, high income, hedged equity, even if it's fixed income or alternatives like Bitcoin, real estate, and gold. That's where we want to be. We want to be in that space and continue to grow. So we have more funds that we're looking to bring out this year, and we're really excited about the 12 we have out right now.
Tariff tantrum, if you will. We saw on April 9th, the S&P 500 went up 9.5%. The VIX had a huge spike as well, one of the biggest spikes since 08 and 2020. And April 8th was the bottom from that huge, I guess we could say, pullback, quote unquote, decline in the market. One of the largest sell-offs I've seen in quite a while since 2020. And taking a look at the 1 year of returns, I saw that on April 8th, QQQI and SPYI only went down about -6% in terms of total returns on the 1 year chart, which outperformed the S&P 500 and the NASDAQ 100. And then on April 9th, after that huge spike, we saw that once again, QQQI and SPYI were beating the indexes. We saw that both QQQI and SPYI were able to deliver some pretty solid returns from that huge bounce back. Can you walk us through how NEOS navigated that highly volatile environment and captured hopefully the best total returns possible for your guys' products from SPYI and QQQI?
Sure. So I'll take a step back and think about how these portfolios are constructed, and I'll use SPYI as the example, and it flows over to QQQI really well because you're just replacing the S&P 500 with NASDAQ 100, volatility from the S&P 500 in the VIX with volatility of the NASDAQ 100 in the VXN. So if you're thinking about how these products work, we roll these products on a monthly basis. The duration is a little longer, so about 7 weeks or so. And I know we've kind of gone through this, but I think it'd be really good just to give a little bit of background. So as we're talking about how we rolled going into early April, how it makes sense and how the products performed. So when we're rolling at the end of the month, our models are looking at a few different things. They're looking at volatility, the rate of change of volatility, and a few other factors to decide not only how far out of the money the call should be, but on how much of the notional should be covered. Part of that plays into what the target range of income is on an annualized basis for each fund. So for SPYI, as you know, it's 10 to 12%. For QQQI, it's a little higher because volatility is a little higher in the NASDAQ 100, and it's right around 13 to 15%. So all those come into play into our model. And when we rolled at the end of March, if you think about where we were, volatility had been picking up month over month. And we were seeing more and more volatility going into those tariff announcements. So the VIX was sitting right around 22 or so at the end of March, which was much higher than where it was the month before and way higher than it was the month prior to that. So if you think about the VIX sitting at 22 at that time and volatility starting to pick up, as you mentioned, when we rolled the products, SPYI, our model told us that we could sell calls a little bit further out of the money, still bring in a good amount of income, and we only had to write on about 60% of the portfolio. So that left about 40% of the portfolio uncapped by those short calls. Prior months, we may have been 75 or 80% covered, which is a higher notional coverage when you're thinking about selling calls on the portfolio. So as we rolled into early April, the tariff announcements came out, as we all saw, and you just said, the market sold off, volatility spiked. We haven't seen closing levels in the VIX this high since COVID. So we had closes over 40, over 50. We haven't seen that since COVID. We saw last summer, we saw a spike in volatility in August, but that was a one-day spike. It didn't close. I think it closed in the high 30s. But when you're thinking about where volatility was in April compared to where it was during COVID, you're starting to really get the markets going again. So we have this sell-off, and remember how these products work. SPYI and QQQI are not hedged, but they should outperform in the flat to down markets by the amount of premium you brought in from selling those calls. So as you were saying, they were outperforming. And then as the market turned around and we had that announcement that April 9th and the market shot up over 10%, it was about 9.5%, I think, in the S&P and 12%, if my numbers are correct, in the NASDAQ 100. SPYI and QQQI were in a position to capture almost all of that upside because we hadn't capped too much of the portfolio and the calls that we wrote were further out of the money. So they sold off and then we were able to capture that. So for us, we're following our rules-based strategy. We're not changing anything. A lot of people had asked us, suddenly the VIX is at 40, at 50. Are you rolling down? Are you selling calls down here and trying to bring in a lot of income to distribute? And the answer is no. We follow our rules. We follow our model. And if we had done that, we would have capped our portfolio down much lower than where it was. So if you look at, a lot of people look at April and they're like, if you didn't really follow the markets, you look and you see the market was, S&P was down a little, the NASDAQ 100 was up a little. Did much happen in April, but we know a lot happened in April. So you think about how that rolled, and then going into May, same thing. Volatility was still there. It wasn't at 50 anymore, but it was still in the mid 20s when you think about the VIX. And for SPYI, when we were rolling that, we were able to still keep that notional coverage around 60%. And for QQQI, it was more like 55% or so. So you can see as the market continued to rally going into May, we were able to capture a lot of that upside because we weren't capping the upside. We brought in enough income. We weren't looking to try to bring in additional income and try to distribute that out. We were bringing in what our target range is.
Were there any changes in the prospectus for both of those flagship funds?
No. We followed our rules. And it's a good test to kind of give people an idea of how these products, whether it's ours or others you're looking at in the space, how will they react in these different environments? When volatility spikes, what are the rules based around that fund? What are the distributions going to look like? What does the total return look like, more importantly? And I think for a lot of people, April was a very good test to say, wow, this fund did exactly what I wanted, or maybe that one didn't do what I thought it would do. So it's nice to have these little vol events so you could see what happens in the market. You could see how it tests your portfolio and individuals' holdings. And for us at Neos, all of our funds that we had out did exactly what we knew they would do in these environments. We knew that in certain environments, they would react this way. And, April happened and they did react that way. And then the market rallied and we knew how it should follow after that.
Can you go over how will SPYI and QQQI perform in an upward trending market? I know you just described this, a flat market. and then a downward bear market, because I know a lot of investors have these two products as like the core of their portfolio or like the highest positions in their portfolio. So I think they want to hear how these two ETFs would perform in a bull market, flat market, bear market.
Sure. So again, in the flat to down markets, you should outperform by the amount of premium you're bringing in. And if you think about a trending lower market, volatility will most likely be moving higher, and we could bring in more income. So we would probably, as the market's going lower, write on less and less of the notional. So when the market does rally, eventually we could hopefully capture a lot of that upside. Now, if the market is grinding higher and volatility slowly coming in, we should be able to capture a lot of the upside. Depends if you have like just a grinding higher, or are we having a 10% spike in 1 month? You're not going to capture that in, covered call products in general. You're selling calls and selling away your higher, total return potential in the fund because you're capping your portfolio at some point. For us, you were selling it out of the money on average. SPYIs anywhere, the short calls are anywhere from 1.5 to, call it 3.5, 4% out of the money on a monthly basis. And as we roll that, we're rolling that out. So if you're up 1% a month, you should be able to capture a lot of that upside. If you're up 10% in a month, you might capture 60 or 70% of the upside. And then there's that portion of the upside you just can't capture because you have those short calls, even if you're not covering all of the notional.
Can you provide a brief rundown of the investment objective and just a quick rundown on these two ETFs for investors?
Sure. So SPYI is our S&P 500 high income ETF, and QQQI is our NASDAQ 100 high income ETF. And what we're looking to do in these products is we're looking to give you exposure to, say, for SPYI, the S&P 500. We're long all 500 names in the S&P 500 in the same weighting. We're not trying to do anything different from an equity standpoint. We want to hold all those names. We like the S&P 500. When they add a name, we add it. When they delete a name, we delete it or rebalance. So from an equity standpoint, for both of these funds, we're just tracking the underlying index, whether it's the NASDAQ 100 or the S&P 500. Where our active management comes in is the call writing strategy that we're using. So for both of these products, we use index options. We use S&P 500 index options on SPYI, and we use NASDAQ 100 index options in QQQI. And I know, Marcos, we've talked about this before, but there's a tax efficiency that you get by using those index options. They're classified as 1256 contracts. And from the IRS standpoint, the 1256 contracts get a 60% long-term cap gains treatment, 40% short-term cap gains treatment. So when you think about the profit that might come off of one of these option trades, that 60-40 split, when you're rolling it on a monthly basis, is very important to the overall tax efficiency of the funds when it comes year end and everybody gets their 1099s and they're looking at what they're doing, because that you get that 60-40 split, getting that more favorable long-term tax treatment from a portion of it is important. What we're trying to do in these products is not only put out a good distribution, 10 to 12% range is the goal for SPYI, and for QQQI, the goal is in the 13 to 15% range. It can be a little higher, can be a little lower, depending on volatility and a few other factors, but that's kind of the range and where it falls. So it's not only trying to get a good distribution, but try to capture as much of the upside of those underlying reference assets as we can. Since inception, SPYI's caught about 3/4 of the upside of the S&P 500 while still providing that monthly income in a tax efficient manner. QQQI has been out not as long as SPYI. SPYI is coming up on its 3-year track record at the end of August, so excited about that. But SPYI has been out since early 2024, so about a year and a half. But we've had a really nice total return and has captured a lot of the upside of the NASDAQ 100, still providing that income off of the options portfolio.
When people think of cover call ETFs, they think, okay, I'm just going to underperform heavily the underlying asset. But with these two ETFs of SPYI and QQQI, I think to my memory, you guys are just barely trailing the S&P and the NASDAQ 100. So how are you guys able to be in line with it almost? When it goes up, you guys go up. And when it goes down, you guys go down less. But on a total return standpoint, if you factor in the income, you guys are just trailing it by like 1%, maybe on the 1-year chart. How are you guys able to mimic the S&P like super, super close while providing that high monthly income that investors like and I guess want in their portfolio?
Yeah, no, it's a good question. I think when you think about it, it all goes into the rules-based strategy that we're doing. We're following the rules-based strategy. We're not deviating from it. Like you asked, was there a change in April? The answer is no. We know what our products should do in different environments, and we follow our rules. And it's really important to us. A lot of people will ask, well, how much discretion does the portfolio manager take? And whether it's me or Garrett, we're following the rules. If we're not here one day, we have an experienced team on the trading desk of 3 professionals that can know all the rules and can manage the products. So it's very important to understand that we're following our rules that we developed and we made. And it really, those rules are really to, like I said, like capture a lot of the upside of the S&P 500 or the NASDAQ 100, so we can make sure that not only we're providing you that income, but you're capturing a good portion of that upside. Because in the end, people want exposure to the NASDAQ 100 for the growth and for the, the companies that are in there, the Magnificent Seven and so forth. And they look at that and say, is there a way to earn income off it? And in QQQI, you could earn some income off it through an options strategy, but still capture a good portion of that upside. So you have this product that is a little bit of a lower vol product than the NASDAQ 100 itself, provides you more income than the NASDAQ 100, and can, possibly slightly outperform in the flat to down markets and then capture a lot of the upside in the up markets.
People have, like I said before, a lot of money in these cover call ETFs. We're seeing new issuers come out left and right with new products, and NEOS resonates quite a bit with investors. So my question is, I think you just said that, NEOS is here for the long run. You guys aren't just gonna be a ETF issuer that just comes out and maybe, I don't know, doesn't provide what you guys want to investors. Because the biggest question is, okay, if I have a lot of money in these cover call products, these are newer products, will they be here for decades and decades and decades? But I know you guys have like strategic planning, succession planning, the rules-based strategy. So I just want you to quickly touch on if NEOS or how NEOS will be around for decades to come.
Sure. No, it's a good question because, yes, we are a newer firm. Like you said, SPYI is just coming up on its 3-year track record. So for us, we look at it as this is our space. We are option managers at heart. NEO stands for Next Evolution Option Strategies. It's what we focus on. Yes, there's a lot of new issuers coming out. There's issuers that have been around for a long time, and they're kind of dabbling in this space, bringing out a fund or two because it is a very hot space right now. A lot of people are pushing money towards this space because of the income it may provide, or the correlation compared to the rest of their portfolio. So they're looking to get this exposure. For us at NEOS, we are a growing firm. We are based in Connecticut. We have just almost 30 people now as we're growing, and we have a very experienced team. So yes, these are all rules-based strategies. If I'm not here one day, or Garrett, my co-founding partner and portfolio manager, is not here one day, we have an extremely experienced trading team that can handle all of this. And we plan on having these products out for a very long time. I know we've talked about it before, but we've been in the option-based ETF space since the beginning, so well over a decade. We launched a lot of those early passively managed products years and years ago. And those products, while we don't manage them anymore, are still out there with other issuers growing and doing what they do. So for us, we look to have NEOS around for a long time. We're not looking to change that up or anything, but there is a very strong team behind NEOS, not just me sitting here, but a very strong team behind me that helps support these products.
One hot topic right now is the topic of NAV erosion, NAV decline, etc. QQQI and SPYI have none of that. You guys, when you factor out the income and just the total returns, it's been performing super well. But when you hear of NAV erosion and investors complaining about their NAV eroding and whatnot from other products, what are your thoughts on it? And why doesn't NEOS have NAV erosion? It's kind of a weird question, but I'll throw it back to you.
No, it's a good question because it comes up a lot. And I think when people traditionally thought about products like these, they might have been sitting in closed-end funds back, 20 years ago, or maybe some other products that used options and didn't really generate the income that they were distributing out. So for us, yeah, of course, there's products out there that manage their distributions differently than we do. Some tend to potentially over distribute, but that's up to them, and that's part of their investment mandate as they have those products out there. For us, when we have a product like QQQI that can perform well and capture a lot of the upside of the NASDAQ 100, we are distributing out the income, the amount of money that we're getting off the premiums of selling calls. We're not trying to distribute additional income to have a higher distribution rate or a more bigger number out there to say, hey, our distribution rate's bigger than this person. We're distributing what we feel is good for the fund and what is the total return of the fund can handle. So we want to make sure that over time that the total return can support whatever distribution is going out of the fund.
And investors constantly ask me, should I pick only SPYI, only QQQI? Should I pick both? And I don't know how to answer that question. So I'm going to throw it back to you on when investors do their own research and their own due diligence, how should they go about picking either SPYI or QQQI or maybe even both?
Sure. Now, listen, and this is a tough one because it's down to every individual. Everybody's portfolio is different. Everybody's needs are different. Everybody's income needs are different. Everybody's risk tolerance is different. So if you think about it, whether they're just investing in the market in general, are they looking at the S&P 500 or the NASDAQ 100 because they like the growth more of the NASDAQ 100, or do they like a broader based market index like the S&P 500? So that is where it needs to start. And then they need to look at what kind of risk they want to take for the income they're going to receive. If you want to take a little bit more equity risk because maybe you're younger and you have a longer investing lifespan, then maybe QQQI makes more sense. If they don't want to take as much risk, but they still want a high amount of income in that 10 to 12% range, maybe SPYI is good for them. We have a lot of people, think about our products in general, and they go across the risk spectrum. So from as low as a 1 to 3 month T-bill ETF with added option income for a very low vol product, through some more fixed income, then into the higher income like SPYI and QQQI. And then we also have our alternatives that are yielding even more, whether it's Bitcoin or gold. And thinking about those alternatives, it's what kind of underlying reference asset do you want exposure to? And then how much risk are you willing to take to get that income? And that is individual to everyone, whether it's me, you, or anybody watching.
Why don't you have synthetics? Why do you actually hold the underlying?
It's a good question. I think for us, it's very efficient, and it's inexpensive to hold all these names. To hold the 500 names of the S&P 500 is very easy. They're all very, very liquid names, or the NASDAQ 100, very liquid names. For us to buy and custody those at our custodial platform is a very easy and straightforward process. So there's no real need to build a synthetic long around a NASDAQ 100 position or an S&P 500 position, or even to hold one of the ETFs as the underlying, because it's so efficient to hold those names. For one of our other funds, for our, say, Russell 2000 fund, it's easier for us to hold the ETF, just because spreading, across 2,000 names, if we get small inflows, sometimes you have to wait until you have enough inflows to spread it across the 2,000 names to be able to allocate it properly. So then you might have a cash drag. So for us, for that one, we're long one of the ETFs to get that Russell 2000 exposure. And then, as you mentioned, some of the other ones we use a synthetic long, whether it's Bitcoin or gold, we'll use an option strategy to get that exposure for most of the long position.
Are SPYI and QQQI meant to be a long-term buy and hold investment for investors? Because I know that some of these like higher issuer, higher yielding products might be something that you look at for like momentum trading or, buy and hold for a short period of time. But I'm going to throw it back to you on if these products are meant for a long-term investing.
Sure. I think, again, that's individual that fits to every individual differently. But for us, the way we design them is for them to be longer holding strategies. If you're looking for exposure to the S&P 500, but you want income, or even if you're looking at the S&P 500 and you want to be involved in those 500 plus names, but want to have a lower vol product, and maybe you're not even taking the distribution, you're just reinvesting it every month until down the road when you actually need or want to take that distribution. So a lot of people look at it as just having a lower vol product compared to the S&P 500 with the same exposure. So, we look at it as they are long-term products. These are not, I don't really look at them as trading products that you would trade in and out of to try to grab a dividend here or grab some upside momentum there. In my opinion, buy and hold longer term products.
We're basically at all-time highs for the market. So we had a great stock market. Investors might be thinking about hedging, and you guys have two products for SPYI and QQQI of QQQH and SPYH, which are your guys' hedge equity income products. My question is, can you briefly go over, I guess, these two ETFs, your guys' hedge equity income ETFs of SPYH and QQQH? So can you go over the benefits of hedging and how those two ETFs can benefit an investor who might already have SPYI and QQQI?
It's a great question. If you think about SPYI and QQQI and you're maybe invested in them and you like the income coming off them, but maybe there's too much equity risk in there for you. Maybe QQQI giving you a 14 or 15% distribution is great, but you're taking too much equity risk for your personal portfolio. We wanted to have products out there that could say we would take some of that income and give you a measure of downside protection. So what are we doing in this? We'll start with QQQH, which is our NASDAQ 100 version. We are long the NASDAQ 100, all 100 plus names, same as QQQI. Then we are selling a call to bring in income. So very similar to QQQI. We're not covering 100% of the notional on that. It does depend on volatility and where that is. But right now, for example, we're about 75% covered on the short call. We'll take some of that income and we'll buy a long put spread. So what's a long put spread? That means we're buying a put out of the money, and then further away from the money, we're selling that insurance away. We're selling that put. So we're not trying to hedge it to zero. This isn't a buffered product or a defined outcome product. It is a product that will give you a measure of downside protection when the market moves lower and still allow you to capture a good portion of the upside when the market's moving higher. So if you think about how the portfolio is positioned today, like I said, we sold calls on about 75% of the portfolio. And when we wrote those calls, we were about 2.5% out of the money or so. We used some of that income to buy a long put that was about 5% out of the money. And then we sold that insurance away about 12 or 13% out of the money. And that can change. But on the long put spread, it's important to know that's on 100% of the notional. So we want to make sure that that hedge for that portion, that measure of downside protections on the entire portfolio. Whereas if the market's going to move higher, we don't want to cap the entire portfolio. So we're selling on a portion of the portfolio. So for these products, you're still going to capture a good portion of the upside of the NASDAQ 100. You're going to have a lower vol product and outperform QQQI and the NASDAQ 100 when the market does move lower. But you're going to have a lower distribution. So this one is in the goal is the 7 to 10% range. It's yielding right around 9.5. So you're giving up some of that monthly income for a lower vol product, and it's a really great product. We really like it. I think a lot of people look at it as maybe a complement to their NASDAQ 100 or even their QQQI position because they want to lower their overall portfolio volatility, but they still want those NASDAQ 100 names, and they still want that income on a monthly basis. Same thing for SPYH. SPYH is a newer product. We launched that right around April 2nd. So that product is very new. And same thing, we're long all 500 names in the S&P 500. And then we have that dynamic long hedge with the short call. So we're selling that call out of the money. And then we're using some of that income to buy a long put spread. So the put spread's a little different because volatility is a little different in the S&P 500 than the NASDAQ 100, but you're still getting income. So that's yielding, the goal is the 6 to 8% range. It's yielding, 7.5, 7.75 on an annualized basis is what the distribution is.
I was like, I got to have Troy back on because when I think of like a hedged ETF, usually let's say the bullish one goes up like 20%, the bear one goes down 20%, for example. But then I'm looking at a chart and I'm like, wait, SPYH and QQQH go up, not as much as, SPYI and QQQI, but it goes up And then when it goes down less. So I was thinking, oh, is this more of a product for investors who are lower risk, but maybe, or maybe even that have like a lot of money and are freaked out about taking on most of the downside risk of these covered call products, and that just want to have exposure to the S&P, to the NASDAQ, but still capture upside and and I guess you could say, have that downside protection on the downside in a tax efficient manner, because these do have index options, correct?
We are using the index options in these, and you explained it perfectly. It's really for investors that want to take a little less risk, but still want to be involved in the equity markets. They're willing to give up a little bit of their distribution in a QQQI or SPYI in those examples for a measure of downside protection and a lower vol product, but they still want to have those NASDAQ 100 names or the S&P 500 names and earn that, monthly distribution.
How are you seeing your investors in these two hedge equity income products have them in their portfolio? Like, for example, are you seeing them load up on, or maybe are you seeing inflows into your hedged equity income products right now because we're at all-time highs? Are you seeing investors who have these products, I guess, combine them with the long products of SPYI and QQQI? How should investors think about allocating if they are interested in your guys' hedged equity income products?
So right now, the flows that we're seeing mostly are coming into QQQI and SPYI. We have had flows come into the hedge products, but not in the same frequency that we've seen come into the higher income products. And I don't know if that's a testament to how bullish the market, people are for the market, and they just think we're going to keep moving higher. So they'll take the higher risk with the larger distribution. So those products have definitely gathered more assets quicker. But we do see consistent flows into the hedge products. And I think when we talk to advisors and we talk to people buying these products, they're really saying they have clients or they're looking to just lower their volatility in their portfolio. Some of them might be invested in a QQQI or an SPYI, but it's sometimes they're just invested in the NASDAQ 100 or the S&P 500. And they're not looking to replace that, but they're looking to lower that volatility in their portfolio. So they'll buy the hedge product, earn a little income while they're doing it, and overall lower their overall portfolio volatility.
But investors told me they don't want NEOS to ever pay weekly. They just want you guys to stay monthly. Will you guys ever think about making SPYI and QQQI a weekly pair?
We have no plans to pay weekly. Right now, we are paying monthly, and all of our products, whether the 12 that we have out are monthly payers, but the new products we have in development will be monthly payers as well.
When we take a look at the distributions and the income month over month for SPYI and QQQI, we're seeing it being super consistent. I know back in the day, these cover call products on the NASDAQ and the S&P were more volatile. So the question is, how are you guys able to pay such a consistent distribution month over month? I know in April it was a little bit lower, but barely. We're seeing like a super stable distribution, which is great because people plan out their next income check. They rely on NEOS products for income and whatnot. How do you guys pay the distribution so consistently and reliably?
So for that, we're managing. Part of the model is looking at this distribution range. So when you think about SPYI, it's that 10 to 12% range is kind of the range we want to fall in. And so our model's working around how much notional coverage and how far out of the money to write calls to fit within that range, because we want it to be as consistent as possible. For April, for example, you mentioned, I think it was lower, but that was on a dollar basis. If you look on a percentage basis, it was actually higher. Remember, we had the market sell off. So when the distributions went out, it looked like you maybe got, fewer pennies less than maybe you did the month before, but on a percentage of NAV, it was actually a little higher because vol was a little higher. So, but we're not looking to really outside of, there are months where it might be a little higher than the range or potentially a little lower, but we're trying to stay within that range on a monthly basis to have that consistency, which I think is important to people when they look at their portfolios, they look at what the products are doing, and they understand what the products are doing. So that's one of our biggest things is education in any way, whether it's forum like this or others where we can educate and talk about our products or just the markets in general. We're happy to do that because this space is growing so quickly. As you know, there's now over, I believe, 650 option-based ETFs in the market now. And you think about how many are coming out on a monthly basis and how many pun intended, options there are for people as they're looking at this space and thinking about, I want an option-based ETF that's going to provide me income, and they hit search in Google and suddenly a million different ETFs show up. I think the education around the space is really important, and knowing what you're getting, being able to, ETF structure is great. You could always go to our website, pull up our holdings, and understand, oh, there's all the equity names in SPYI. These are the short calls they're in right now, the actual strikes and the expiry. It's very important, that transparency, for people to really educate themselves and understand what they're investing in.
One common mistake you see investors make who invest in SPYI and QQQI, and maybe we'll also throw in SPYH and QQQH.
One common, I think it's probably not understanding the products as well as they may think they do. I think a lot of people just pull up and maybe source by distribution yield, and they'll pick a ETF based on that. And I think it always comes back to educating yourself of what you're investing in. If you're going to buy an individual stock company, whether it's Apple or Microsoft or pick a name, I think people do a lot of research there, and I think they should do just as much, if not more, research when they're thinking about ETFs, especially in this space that they're going to get a distribution off. It's just all around that education piece, and I think the more the better, whether it's, like I said, coming on and just listening to you, or doing their own homework and really understanding what each product does. There's a lot of different ways they could get the education now, so that part's really important.
What is one ETF that NEOS has to offer for investors in this current market environment that they should look more into and do more research on right now?
We talked a lot about our high income and our largest ETFs being SPYI and QQQI today. I think one that's obviously gathered a lot of assets and has caught a lot of attention has been our Bitcoin product, BTCI. That one we're excited about, and there's a lot of obviously education out there and knowledge people can learn about Bitcoin in general and that part of the market. But again, with those products, you're taking a little bit more risk, different risk. You're taking that risk of Bitcoin versus an S&P 500 or a NASDAQ 100. But with that, the volatility is higher in Bitcoin than it is in the S&P 500. So you could source more income from the options market. So that's one. We recently launched a gold product, IAUI. And that is, as you know, gold has been very hot lately. A lot of people are looking at gold as a tradable asset class again, where it was kind of quiet for a number of years, and now it seems to be hitting all-time highs. And we wanted to get a product out there in the space that gives you that underlying exposure to gold, but can provide some income off the volatility of the options market around gold. So that's been a really nice product. We launched that, not even 2 months ago, and then we've already had some nice assets come into the fund. So that one's a really interesting one, in my opinion.
Thank you so much, Troy, for being on the channel. I really do appreciate your time. If you guys like this video, please give it a like, because this cute puppy did. And go ahead and check out our last interview with Troy on BTCI right here on your screen. I love you guys so much. Crushing the stock market, and take it easy. Peace.